Hey guys, this is Trevor, and today we're going to talk about how to analyze a self-storage deal. So the first question is, are you buying the business or are you buying the business and the land? Because that's really important. You need to know, because if you're not buying the land, then that means you are leasing the land while you operate the business. The second question is, are you getting a loan or are you going to pay cash for the whole thing? Know the difference between your cash-on-cash return and your IRR. Your cash on cash is your annual return on investment. And it just means basically your annual net cash flow divided by your investment. If you paid all cash and the example that you mentioned in your question was $400,000 and you wanted to make a 12% return, then you would be hoping to get $48,000 of cash flow per year. That's not your internal rate of return though. That is just your cash on cash or your annual cash return. So having a desired return of 12%, I will just tell you right now, anybody who promises you that you're going to get an annual return of 12%, that means you're taking on a riskier investment. Anytime somebody says you're going to get double-digit returns, that means you're taking on a riskier investment. It doesn't mean it's a bad investment. It just means that you need to do your due diligence, which we'll talk about in a minute. All right. Next question was, how do we analyze and how do we know what we're looking at? So I will say that the next thing that we want to do is look at the financial statements. So you're going to have your income, and then you're going to have vacancy, right? And I think in the self-storage, you assume a minimum of 10% vacancy. But part of the reason that self-storage requires a return that's higher maybe than others is because it's more risky. You have to really be in the top tier of your competition in your local market in order to not be suffering, more vacancy and losing customers to your competition. And there has to be enough demand. So it's not going to be just guaranteed that your storage facility is going to be full, right? So you always have to assume some vacancy. And then you're going to have taxes and insurance. You're going to have advertising, marketing, all of your other operating expenses right there. And that is going to give you your net operating income. But you may or may not have gotten a loan. Did you get financing, like an SBA loan? If you have debt service or loan payments on that loan that you got to buy the business, then you're going to have to, from your net operating income, you're going to have to pay your debt service. So minus your debt service, and that's going to get you your net cash flow. That's the number after you've paid all of your expenses and your loan. And then you'll know what your annual return is. So you'll take your annual net cash flow and divide it by however much money you invested. If you actually are able to increase your NOI, then you will have increased the value of the business and the property too. So when you go to sell, you could turn a profit there. Once you analyze all of that after you've exited, then you'll be able to tell what your IRR is projected to be or really is. Now, when you're looking at the listing, say like on LoopNet, this is where it gets really important. Now, you have to understand the market. There are probably lots of opinions on there about what market conditions make for a more successful storage facility versus maybe a less successful one. So whatever you do, you have to do your due diligence, okay? So what does that mean? It means the first thing you need to do is you need to look at the last 3 years of profit and loss. And that means even looking at the bank statements, if you can get a hold of them. But you need to know how much revenue and expenses this property is taking in. And if the seller of the property or the broker does not show you financial statements, then you should walk, because that means that they've got something to hide. So you're going to want to look at 3 years worth of bank statements or financial statements, 3 years worth of tax returns from the business, you should be able to always get a look at the current rent roll, and that would be the list of all the tenants in the storage facility and how much they're paying each month. The financials should make sense. You should be able to tie what the summary in the financial statement says to the tax returns and the bank statements, and it should all be above board. The one thing that I noticed when I was looking through LoopNet, a lot of these had prices, but they didn't have any income and expenses. So there's no real way to value the storage facility or any commercial property unless you know the net operating income. And so that means you have to be able to look at all of the line items from the income and the expenses in order to get the NOI. Because the way that you get the value, remember, is value is income over the cap rate. So you would take the NOI, divide it by the cap rate, and that gives you your value. And you will have seen this in the courses, but the value is the NOI divided by the cap rate. Keep in mind that you're going to have typical business and operations things to deal with. You're going to have marketing and advertising that you have to pay for in order to attract tenants. You're going to have security systems in place. You're going to have to deal with taxes, insurance, maintenance. You've got to have a staff appropriate for the size of the storage facility that's competent, because in the storage business, you are only as good as your management. And if people want to come and rent from you, and if there's multiple competing storage facilities in the area, they're going to look and which one looks more secure, which one is going to have maybe heating and climate control, which one's going to have better access, maybe with trucks, cars, what have you. It's going to be different in an urban area than in a rural area. Then you're also going to have all the regulatory things, because what happens if somebody goes delinquent? Depending on what state you're in, you're going to have certain laws that you have to abide by when you repossess or auction off people's belongings. You're going to have legal costs, because there will always be the chance of a lawsuit when those type of things happen. So just know that you're going to have to run it like a business. It's not going to be what a lot of people want, passive income. There's no such thing as passive income. Any good investment has to be managed at some point. We'll talk about what to expect in a loan and the financing options maybe in another video, but you would have to get a typical SBA loan or maybe a loan from a local regional lender. So you should be expecting to have to put at least 10 to 15% down, and potentially more, especially after all costs and fees and depending on what the laws are in that state and what the financing market looks like. So just be prepared for that. Now let's go take a look at this listing. Okay, here's the listing that I pulled off of LoopNet. Let's take a look at it. Here's what I see. So we got 48 units. It's 9 by 10 for $50 a month, and then 4 big ones at $300 a month. So they're saying that they're getting $3,600 a month in total rents. So that would mean that they're getting 12 times that every year, right? So let's take a look, and we've got $3,600 a month times 12. Should be $43,000 a year. Now that's gross income. They'll say as is, this is what they're actually collecting, which is pretty good. It shows that they're 90% occupied, and you would want to just verify those numbers. They're saying this is what it could be. They're only assuming 5% in vacancy, which is a little optimistic. I think you'd have to be just really competitive in the market, but it's not necessarily incorrect. This one doesn't show any other income, such as like truck rental commissions. If you're buying in an urban area, you can usually partner with one of the truck rental companies and maybe get some additional income there. Laundry machines, vending, they're just not showing any of that on this particular property, right? Here's another thing, that if you're not going to manage the property yourself and manage the business yourself, like if you're going to continue to be in the service and you're going to be outsourcing to like employees or property manager, then you will have property management fees, and they will never be less than 5% of the gross. So that would come out of this number as well. So every month, if you're paying 5% property management fee, you'd be paying a little over $2,000 in management fees. And then they're not showing any repairs and maintenance here. Of course, you're going to have taxes and insurance on any property. So this implies that this business is being sold with the land. But it's very important to make sure that's in the contract. don't buy any of these without a broker or an attorney. I always recommend hiring your own broker, especially if you don't know the market and maybe you're new to this type of investment. So here they're not showing any replacement reserves, which would be money you're putting away for bigger projects or capital improvements or maybe a new roof or anything structural. They're saying pretty minimal utilities, no legal fees for evictions or anything else like that. So in my opinion, I would expect to see a lot more line items of detail being showed here. So I don't really, and this is just my personal opinion, but I don't really believe what I'm seeing here. So you want to make sure that they're being really upfront with all the expenses. But let's just assuming this is what they were talking about, then you would be looking in this particular investment. They're saying that they're going to get $32,000 of NOI, which is obviously ridiculous. There's no way that their total expenses are only $6,800 a year. So this is why you got to do your due diligence and make sure you're getting the investment that you think you're getting. And then finally, the way that they're doing this is they're taking this number, this NOI number, 32,854, and then they were dividing it by their asking price. Or another way that sellers will come up with the number is they'll figure out what their NOI is, or what they're saying it is, and then they'll find out what cap rate other similar properties have been selling. And that's the proper way to do it. You take your actual NOI, divide it by the comparable cap rate, and then you get your value. Now, make sure that you look at historical sales to see what other similar property types have sold for, similar like self-storage, and then you'll get an idea of if you're paying the right amount. So I would encourage you to continue to look at these deals on LoopNet or any other multiple listing service. And the more deals that you look at, the more that you will get familiar with the standard expenses that go into operating this type of business or this type of property. It's very similar to other investments. You just have a slightly different profile because of the types of tenants that you have and the different types of expenses. So that's just in a nutshell. I'm going to save some links down below and post them so for you to just do a little bit more research on the ins and outs and why you, or what you need to be looking out for when you are investing in self-storage. But shoot me your questions. Again, thanks for your time and your questions, and we'll talk to you soon.